Now, Leslie McCormick of the Farwell Group, author of Bank on Yourself Why Every Woman Should Plan to Be Financially Single Even If She's Not, joins us. Good morning, Leslie.
Good morning, Marilyn.
What do you have for us today?
Well, it is tax time, and you may have already finished filing your tax returns or are working away at them. But for those who are retired or who are planning to retire soon, this is an important time, not just for filing taxes for last year, but actually looking forward and assessing whether or not your income setup is in a tax-efficient way. You've heard us say it before. For most Canadians, one of their largest expenses in their lifetime is taxes. It can exceed the combined costs of your mortgage, children's education, travel, and cars. Having a tax-efficient income in retirement is really important for reliability and longevity of your income, for having your wealth last your lifetime, as well as for having the choice to leave a meaningful financial legacy. While investment decisions shouldn't be made purely for tax reasons, having an eye to how and where your income is being generated with the view to tax efficiency is important. And this is the perfect time of year to look at what drove your tax bill last year. Look at current and future years' income to see if there are reasonable ways to help you keep more of your income. Retirement income taxation can be very different from your working years. Withdrawals from different types of accounts are taxed differently. Investment types in a non-registered account are taxed differently from, say, returns in your tax-free savings account, your RRSP or RIP. How and where you invest and where you take your money from makes a significant impact on your tax bill and things like old age security clawbacks. Now, imagine Mary. She's divorced, planning to retire when she turns 60 later this year. She has a good pension that's indexed to inflation, but if she looked at the value of where she would get each month if she took it at 60 versus what she would get if she deferred to 65, Mary might prefer to wait to take her pension. Her challenge is how to generate her income in a reasonable, tax-efficient manner from her ages of 60 to 65. Mary's second concern relates to her health and well-being later on in life. She wants to be able to afford quality care if she needs it. And since she's single, without any children, recognizes that she would need to pay for that assistance. Ideally, Mary would like to age in place rather than have to sell her home. For Mary, our first question is, how much does she need after tax each year to be comfortable? That is her tax-efficient after-tax income goal. Next, look at what her sources of income are. For Mary, in her circumstances, and since she isn't contributing to her CPP pension, it may make sense to take CPP at 60. That would be her first block of income. Mary has a non-registered account, say, that generates about $25,000 per year in natural income from good quality Canadian company dividends. She's already having to pay tax on those dividends each year, and so it may make sense to rely on that cash flow now rather than continuing to reinvest. And the gap, we like to work through a few scenarios in retirement plans, test out some scenarios to see, does it make sense to take more from her non-registered account each year, convert her RRSP to a RIF when she retires, use her tax-free savings account, or take from a combination of accounts? Our goal is to identify what strategy would make the most sense for her, that's expected to provide a tax-efficient income for her lifetime, that preserves more of her wealth, and maintains her financial flexibility to be able to handle potential future costs of assistance, to stay in her home and have quality health care should she need it. Remember, more important than what you make is what you keep. For Mary, having a tax-efficient income over the course of her entire retirement should go a long way to helping her be able to do just that.
It is tax time, and it's important to know that you can keep more of that tax and play the game fairly. It helps to have expert eyes on what you're doing and get a strategy in place that works best for you. If you want a second opinion or you want an idea of what scenarios could play out in your life so you can keep more of those tax dollars, then remember Leslie McCormick, Darren Farwell, and the Farwell Group. They're happy to give you a complimentary consultation. One call gets you started. 416-863-7501. That's 416-863-7501. And I believe they have all sorts of literature that's complimentary. So don't be shy. Take control of your financial future and make that call. Ask your questions, get your answers, and perhaps save more of those tax dollars you'll be paying out. 416-863-7501. Leslie McCormick, Darren Farwell, the Farwell Group. Thank you, Leslie, for that valuable information, and it's timely, too.
You're welcome, Marilyn.
Now, Dr. Betty Rosendahl of Thornhill Naturopathic will give us her weekly health tip. Then we'll speak with hearing instrument specialist Edmund Ivazian of Hearing Aid Source Centers of Toronto, matchmaker Linda Miller of Misty River Introductions, and Dr. Vivian Brown, author of The New Woman's Guide to Healthy Aging. And there's lots more to come after that. I am Marilyn Weston, and you're definitely getting it straight from a woman's perspective right here on Zoomer Radio.